Hello and welcome to another installment of our IndexMore webinar series. My name is Nico Katzke, Head of Portfolio Solutions at Satrix, and I will be moderating today's very interesting session. We delve into the risks, opportunities, and mechanics of the global fixed income market and debate the impact that current market volatility has on fund positioning more broadly. Now, looking at my previous webinar introductions, I see a common trend of me highlighting just how uncertain times are. But it really feels like this time is even more uncertain and perilous. Since the military incursions into Iran, oil has breached the psychological barrier of $100 per barrel, up from $68 a barrel a mere 2 weeks ago, while gold has remained steadfastly above $5,000 per fine ounce. Locally, we've seen the 10-year bond yield climb above 8.8%, a full 1% higher than 2 weeks ago, while the rand weakened from 15 Rand 90 to 16 Rand 80, and the local all-share index fell close to 10%. So a lot has happened in the last 2 weeks. To suggest markets have been volatile would be to acknowledge the nose on one's face. Forget crypto, the real wild action, it seems, has now hit traditional finance markets. A worrying feature in recent years that's not due to the turmoil in the current turmoil in the Middle East, but which has been bubbling at the surface for some time, is the lack of typical asset class diversification available from distinct asset classes. The breakdown of common stock-bond correlations and the changing nature of traditional safe haven assets have caused concern for portfolio constructors looking to build robust portfolios for clients. Now, AI concerns, macro volatility, policy uncertainty, and simmering geopolitical risk have all dominated the news flow the last few years. Yet despite the uncertainty, markets have been robust, and those that were overly defensively positioned would have missed out on incredibly strong growth despite all the noise the last few years. Now, as we now reach a potential inflection point in energy markets, it does beg the question as to whether our modern economy can indeed survive a protracted energy supply disruption. A reliable and low-cost source of energy is crucial for further AI development, and even food production, and virtually every facet of our modern existence has become reliant on a stable flow of oil. When pure economics clash with stubborn ideologies, it does create a fertile ground for deep market dislocations. Now, with us here to debate and discuss all of this, the markets and the implications for your portfolio, we have Kareem Shadid, who is no stranger to our IndexMore series. He is the head of EMEA investment strategy at BlackRock. Welcome to you, Kareem. We also have James Turp, fixed income portfolio manager at 91, who is also the appointed manager of our Satrix AM Income ETF. And the panel is rounded out today with our very own head of exchange traded products, Yusuf Wadi. Hello to you all, and thank you for joining us. Kareem, I want to invite you to the proverbial stage first. Now, heading into 2026, you co-authored BlackRock's Investment Directions Report, and in it, you summarized retail investor mood as cautious but willing to take risk, a sort of defensive risk-on approach, if you like. Now, equity flows reached record numbers in 2026, despite AI and inflationary fears and tech-heavy indices. Now, the report also stressed the need to balance adding risk in 2026 by including well-diversified sources of income and prioritizing building resilient portfolios. Diversifying diversifiers has become a key theme. I hope I summarized the report correctly. Now, with this in mind, how reliable are common portfolio heuristics, such as traditional stock-bond correlation assumptions in 2026, and where can investors find true diversifiers?
You did summarize it very, very correctly. Thank you so much for that, Nico. And when we think about the portfolio heuristics and how they look like in the 2026 environment, the one thing that comes to my mind is really leaning into this third theme that you mentioned around diversifying diversifiers, because the correlation between stocks and bonds is at best unreliable, at worst positively correlated on the way down. Let me expand. So we are in an environment where stocks and bonds cannot be relied on in terms of diversifying against each other, because we can have environments where because of supply chain disruptions, because of the inflationary shock that such supply chain disruptions do, bonds could fall at the same time when stocks fall. And this is exactly how things have played out with the geopolitical developments of the past week. We're now in our second week of an unfortunate conflict in the Middle East. And this is exactly the supply chain disruption incident that we have been talking about, where the oil price shock, the gas price shock is driving front-end inflation higher, which is leading to a dip in front-end bonds at the same time that equities are in a swoon, equities are falling. And so this is why we like to have larger sleeves for portfolio diversifiers in today's environment that help cushion these stock bond events. So what sort of diversifiers do we look at? We look at market neutral strategies. These are strategies that are maybe long-short in nature, maybe focused on relative value trades that help diversify by having low correlation to stocks and bonds. We look at gold. Let's remember that we are in a finite resource environment. So in today's environment, whether it is the demand for power and for resources that is coming from AI build-out, or whether it is the supply chain disruptions like the ones that we're seeing in the past week, we have a strong demand for resources. And given the finite nature and the unreliable nature of supply in parts, we expect prices of resources to continue to increase. And this is both across precious metals like gold, which still plays the role of diversification in a portfolio against stocks and bonds. The correlation between gold and stocks and bonds remains sub 0.3 over the past 10 years. But also it includes other commodities, thinking about the materials, thinking about battery metals, thinking even about silver, about copper, and about energy. And so these are some of the ideas we're looking at.
Now, a topic that is today on everyone's mind is also the energy shock that we're seeing playing out following the US's bombing campaign in Iran and possible closure of the Strait of Hormuz. Now, how are you seeing clients respond to this crisis, and have you changed your own internal views as relates to asset class movements in recent days?
So when we look at the energy complex, we have been talking about the idea that energy resilience is going to continue to be a very important theme for investors, even in advance of the geopolitical developments of the past week, because we have been talking about this idea that power demand coming from AI build-out and power hunger from economies is going to continue to drive this power theme to lead to demand to updating electricity grids. This is positive for utilities, this is positive for infrastructure, but also positive for the energy continuum, the energy spectrum across the board. So this is talking about both renewable energy, sustainable energy, which had a performance turnaround that started in May of last year and we think has room to go further, and also includes traditional energy. And maybe in the events of the past week, this has strengthened this view on the sector, but also maybe keeps us focused more in terms of dispersion within the sector on downstream companies as opposed to upstream, because downstream can benefit more from these price rises.
So we are living in a world today characterized by uncertain policy paths, dislocations in typical asset class correlations, and elevated stock market valuations, particularly in growth sectors such as technology. Investors are also looking at developed market debt instruments as having high duration risk in return for low real yields. Now, in this environment, should investors look at equity income and corporate debt as fixed income diversifiers? And should there be a greater focus on yield earned from bonds over the management of duration or interest rate sensitivity risk?
This is exactly the theme that we focus on when we look at income in today's environment. It's this idea that bonds have become a greater source of income, given that yields have reset higher post-COVID and continue to be more elevated than the pre-COVID period. So we like bonds for income, the income opportunity that they provide. And we feel that all-in yields in bonds are enough to compensate us for any spread widening. Something that we have seen in the past week is, of course, some widening in the spreads in areas across credit because of the risk-off tone in markets. Yet we think the all-in yield is more than compensating for this risk. And so we like bonds for income. We are a bit more cautious when it comes to duration risk. Remember that duration risk here is getting whacked by the supply chain disruption, the potential inflationary shocks. And while there might be some opportunities starting to open up in front-end duration because the market pricing of the rate path for major central banks has become excessively hawkish, you're looking at the market pricing only one cut or even less for the Fed this year. You're looking at almost no cuts priced for the Bank of England now after the moves of the past few days, and you're looking at almost a hike price for the ECB. So things have shifted quite quickly and quite drastically in the past week, perhaps excessively so, which means that there could be some front-end opportunities opening up in the front end of the rates market, but we still are cautious on duration. We're cautious further out. So we prefer to take more spread risk, all-in yield risk over duration risk in today's environment where yields do remain elevated and cushion us. And we like the carry trade over the medium-term horizon over the course of this year.
So that's interesting. And so to summarize and tell me if I'm right, so it's more the focus is on income from bonds as opposed to rate sensitivity, i.e. the price movement should there be a cut in rates and you get that appreciation benefit. So the focus is very much on income as relates to developed market debt.
Absolutely. That's exactly how I would frame it.
That's really interesting. Now, another hot topic, Kareem, today, especially for South African investors, is the sharp rise in the price of gold that we've seen over the last 12 months. Now, are you seeing large institutional investors continuing to reallocate to gold from traditional safe haven assets like US Treasuries in light of heightened political uncertainty and inflationary fears? And can prices above $5,000 of fine ounce actually remain for the remainder of the year and this be sustained as a result?
We are bullish on gold, to put it very simply. Even though gold has hit record highs over the past year multiple times, we think that gold has a pretty diversified set of buyers and a pretty structural driver to continue to do well. First and foremost, emerging market central banks. They have been buying gold in size since 2022 in order to diversify from dollar reserves. This is a long-term structural theme that is not going to change anytime soon. Some of the central banks in emerging markets are more price sensitive than others. I look at the PBOC, for example, in China, who tend to be a buyer on dips. And so, and we have seen them buy the dip in gold over the past couple of weeks. The data suggests this has happened. So we do see that EM central banks continue to be a large buyer and in fact provide a pretty steady floor for the gold price. Then we look at other buyers. You've got the retail community. Sometimes the positioning there gets stretched and then gets unwound. And so it goes through cycles of positioning. And we have to acknowledge that, which has led to a rise in the volatility of the gold price. So from a Sharpe ratio perspective, gold is probably not as cushioning as before. But even accounting for that, the risk-adjusted returns for gold do remain attractive, and we like them in a portfolio, in a multi-asset portfolio. And we like the diversification qualities, so the reduction in correlation qualities versus stocks and bonds. So we've got the retail investor. We've also got institutional investors. When we look at ETP flows, they have been going through more and more buying, so continued inflows into the space. I would also mention gold equities. Gold equities, their margins are driven by the gold price minus the oil price. So of course, in the past week, if you were to look at it just from a 1 week horizon, the delta has been perhaps negative because of the surge in the oil price, which is an input price, whereas the gold price is an output price for these companies. However, when you zoom out, the bigger picture is that their profit margins have gone through a structural reset higher, and we don't think the past week changes that. So this general surge in the gold price still far outweighs the surge in the oil price, and from a margins perspective, their margins remain a lot better than they were a couple of years ago.
That's a very interesting point. And we've in recent weeks had quite a number of discussions with intermediaries locally around exactly this point that you're making, is that the miners have deleveraged over the last decade and a half since the last commodity super cycle that we saw in the early 2000s, where a lot of the mining companies and resource companies more broadly used debt to acquire assets in order to increase production. Of course, what followed was the global financial crisis and a decade that followed of heightened volatility. I think we almost need to reset our expectations around resource companies and mining companies around the fact that if you're not as leveraged as you were kind of in the aftermath of the global financial crisis, means you're far more robust to a volatile commodity price, right? And I like the fact that you alluded to gold and specifically mining companies, because it's two different propositions, right? And you're talking about more stable companies that actually have better resilience on their balance sheets, far lower debt ratios, and are looking quite attractive, even at these elevated levels. So yeah, really, really interesting what you're seeing. And just briefly, in terms of access to seeing the most value.
I lost you for a couple of seconds, so I didn't hear the keyword. The access to value of? Sorry.
Apologies. So where are you seeing the most sort of value in mining companies and resource companies more broadly? EM space, I mean, where are you seeing kind of the opportunities?
Absolutely. Yeah. So as I was saying, we're looking at gold and broader metals mining companies. So this is really a broad universe of companies. We also look at, NatRes as a theme more broadly. So it's not just specific to gold, because of the supply shortage that is not meeting the demand, the structural demand. So you could almost call it a commodity super cycle that we're at the foothills of, in our view. Driven by both the geopolitical dynamic as well as which drives gold demand as well as drives oil demand at the moment, and oil supply disruption, and also beyond the geopolitics, importantly, the power demand theme and the AI demand theme, which is structurally going to continue to be here.
Now, Karim, if we can next turn to emerging market debt instruments. Now, the last time you and I spoke, you mentioned the attractiveness of EM debt in light of a weaker outlook for the dollar and developed market fiscal stresses and the like. Are you seeing a growing demand for EM debt in client portfolios, or do they remain underweight relative to, for example, the global aggregates 17% EM debt exposure? Do you see value outside of Asian debt also, which accounts for the bulk of that 17%? So how are clients currently positioned?
EM debt saw about $11.5 billion of inflows in ETP flows last year, and that's a record. So there is no doubt that we have record flows entering the EMD space from investors, and this demand is driven by this idea that EM debt has actually been trading at a very good yield per unit of volatility perspective. So it has been a very stable source of carry in fixed income, which again, as we were discussing earlier when we were talking about our fixed income outlook, this is a theme that we really like, the carry theme in fixed income, the idea that you can get good yields that cushion you for any duration risk. Well, EMD does not have a ton of duration risk, especially local currency EMD. And so we like this exposure a lot. Now, when we look at the local versus hard currency differences, it comes back to something you mentioned, Nico, which is the universe of the assets. So hard currency emerging market debt, it tends to be more evenly split across regions. So you're talking about almost a third of hard currency emerging market debt coming from Asia, a third from the Middle East. And Europe, remember, the Middle East is a very large issuer of dollar debt, talking about the GCC, which is why they form such a big part of that index. And then a third from LATAM. Whereas EM Asia is mostly Asia. EM local is mostly Asia. EM local debt is more than 70% the Asia universe. So it depends on your view there. We like the diversified nature of EM hard currency debt. However, we are cautious that there is a lot of exposure to the GCC, which could be going through some price volatility at the moment with the events there. But if you see through that, the fundamentals remain very strong. So if you're looking at the longer term time horizon, then there are opportunities opening up, and EM hard currency remains a really attractive investment. As for EM local, with the majority in Asia, the question there becomes the outlook on that space. Of course, there is some fiscal account and balance of payment deficit likely coming from the shock in energy. 80% of energy flows coming out of the GCC go to Asia, so there is no doubt an impact there. But it is all to be seen how the situation evolves. Again, beyond the tactical, we also like this space.
Very interesting. Thanks for your insights, Karim. That was fascinating to hear your thoughts there on quite weighty matters at the moment. So thank you for that. James, if we can turn to you next. Are you there, James?
Yes, I am. Hi, Nico.
Hi, James. So just a really interesting time to be in the markets, James. You have all my sympathies and condolences being in the fixed income active market at the moment, because I can imagine it is quite a ride. So thank you for taking the time to share your insights and views with us. Just wanted to remind the audience, you're more than welcome to use the Q&A button that you'll see on the right of your screen. So any questions that you have for James or any of our speakers, just drop them in and we'll be sure to address them. Now, James, in contrast to developed market bonds, as we've been discussing with Karim, the local bond indices had a phenomenal few years, earning investors equity-like returns. Now, how should investors think about prospective bond market returns from here? And are we in a new regime, or should we prepare for more muted performance going forward?
And thanks a lot for having me back on the IndexMore webinar. Pleasure to be here and join Karim and yourself again. And it's a tough week, as you say, to comment on risk markets at the moment. So I think we need to take a step back, as you say, considering that South African bonds did 17% plus in 2024 and 24.25% last year. So like Karim was saying, where investors are looking at these higher yields for income. In South Africa, we were looking at a recalibration of our risk metrics, which were resulting in a capital appreciation trade, because those risk margins we've been factoring in for so long were being priced out. So that story, of course, isn't one that carries on into perpetuity, and that's become the strategy for this year, is to work out where yield should be. And that comes down to our structural changes that we've experienced. You've spoken earlier about gold and commodity prices, and those were a big factor in our budget last month, where we've had massive tax improvements because of our own commodity exports. Those improvements are things that we've had to factor in, combining that with a lower inflation target that was introduced last year. And with a lower inflation target and with the credibility of the central bank here, it means that yield and bonds are still an attractive buy overall in South Africa. The question, of course, is how these assets will react in times of volatility, which we're going through at the moment. So you've got to kind of dislocate your view short term and longer term. And I think the longer term view here in South Africa is, if we can look through what is an energy shock and an inflation shock that is building and growing at the moment, then we will find ourselves in a lower inflation environment here in South Africa. And so bonds and the positive sloped yield curve will still offer appeal to our investors. And most importantly, that diversifier that in normal markets we will enjoy being.
Wouldn't we give what for normal markets to return again, James? Now, you mentioned the low inflation target, and South Africa's shift toward a lower inflation target is a major policy change. How credible is this transition, and what does it imply for the long-term pricing of bonds and inflation-linked assets from your perspective?
Yeah, the South African Reserve Bank has really earned its stripes as a credible global central bank. If we think back over the last 20 years, we were comfortable with higher inflation closer to this 6% level, which was the upper part of our target, which was a band of 3 to 6%. And then with the change of governor and with Lesetja Kganyago coming in, he then explicitly adjusted the inflation target to the midpoint at 4.5. And he actually anchored it there through credible monetary policy. And it all hinges on expectations ultimately that determine economic behavior in the country. And so he actually managed to get it from, if you look prior to that change, the average inflation rate was indeed in the upper fives, and after the explicit adjustment, close to the target of 4.5. And it's on the back of that, and also opportunism. Of course, our inflation level is closer to 3% at the moment and has been there for the last year. So using that disinflation opportunity combined with credibility makes the market believe that we can get there. And that's been evident in the pricing of inflation break-evens that are inferred by inflation-linked bonds, that we've had 5-year close to 3.5% average inflation over 5 years. And the 20-year level came down from, it was close to 8% in 2024, coming down to below 6% at a point. So that is the talk of credibility in the central bank's ability to get it there. Now, of course, we are a little turned on our head with the oil price doing what it is at the moment, and combining that, and this goes back to the correlation point Karim made earlier, where he said those normal correlations aren't factoring in a risk-off environment. And that's exactly what we're seeing at the moment. This inflation shock comes in the form of higher oil prices and a weaker rand. But we have seen in prior crises that the Reserve Bank tends to look through first-round shock effects and waits to see if they show up in second round, which takes a little bit longer to come through. So the coin is still in the air at the moment, but the market is responding. So the market does that because it knows that the central bank has a reaction function. It's pricing in slightly higher rates, in fact, now in about 8 to 9 months' time. So I think that talks to credibility of the central bank, that they have the ability to get inflation to 3%. It's an ambitious target, I must say as well, but I believe, and it's evidenced in those expectations coming down, that overall they will be able to get it there, I believe, if everything else behaves.
And that's a great point around expectations and setting expectations. So if economic theory teaches us anything, if you can anchor expectations at the long end to a lower inflationary level, that itself begets lower inflation. Because, of course, through wage bargaining and other means, people do look at what the nominal inflation or the inflation target of the central bank is. So it does have an effect. So I think the timing of moving it lower was opportune. It remains to be seen whether inflationary pressures from energy shocks will have a different say. But like you say, the coin is firmly in the air still on that. So it would be very interesting to see whether there's longevity to this lower inflationary target. I want to turn very briefly to the macro side of things, James. Now, global markets, rattled by geopolitical conflicts and rising risk premia, that's state of play at the moment. Now, how should investors assess the South African fixed income part of their portfolio when building resilient portfolios? Because what we're seeing globally is we're seeing very high duration risk, very low real yields, and the proposition, if you like, for global bonds for local portfolios do not look all that attractive. What distinguishes local bonds from global peers in the risk-off landscape?
Yeah, that's a really good question, Nico. And we do need to think about portfolios as being diversified. South African equity markets are quite highly concentrated to industrials to commodities, and the currency does play a big role in that as well. So when we look at building a diversified portfolio, South African fixed income still offers value. I think that value comes in two forms, though. It's not only the duration, it's also higher real yields that we've got. With that lower inflation, we've still kept our real yield quite high. With our repo rate at 6.75%, inflation at 3.5%, you've still got 3.25% current real yields at the moment, and those are supposed to be sitting neutral at around 2.5%. So we've got a bit of fat there in our real yields, and I think that's where we can build some earnings of those yields into the portfolio by finding something that engages not only fixed but floating rate assets in the book. And so that's something to consider. It's also, in times of crises, worth thinking about perhaps stagflation that may play out across the world. That's probably the biggest risk of this oil and energy price shock. And if that does play out, you'd end up getting lower growth, but that's combined with lower inflation ultimately as a result of lower growth, which then comes back to bonds and longer dated bonds as being the attractive part in a portfolio. So we find ourselves in that sweet spot potentially. And with markets having sold off, admittedly, it's been a quite sharp adjustment this week, but that does suggest, you are now finding better entry points once things calm down into potentially a world that goes into a period of lower growth, and combining that in a portfolio that takes a good portion of floating rate, higher real return type assets. I think that's the way to go here at the moment. So those are the sort of opportunities I think that will present themselves through this crisis as well to find some value in the portfolios.
Now, South Africa has maintained unusually high real rates for years. You alluded to it, but I mean, this has been the case for a number of years. Now, as global rates start to somewhat normalize, if you like, what is the likely trajectory for SA real yields? Does the premium remain justified, or is repricing overdue?
Yeah, I think the repricing is probably overdue, Nico. There's pressure on the central bank, that's for sure. I mean, you can't read the press without hearing, in a low growth economy as our own, that every marginal change to interest rates would be welcome. But I think our central bank has got the horse in front of the cart on this one, and trying to control inflation as the primary objective before getting interest rates lower. They've been explicit about that being the causal relationship, and ultimately lower inflation relieves pressure on the most affected parts of the community by inflation. So I think they certainly want to ease rates as soon as they are allowed to. And they do flag, as I say, that neutral real being about 2.5, which is on average, we've got another 3 interest rate cuts from where we are now to get there, of course. So, yeah, I think that's top of mind for the central bank, is to ease policy. We do get that in the commentary over the last few meetings, that they are conscious of that. But I don't think this current turmoil is going to make them sound dovish for the time being, unfortunately. I think this month's central bank meeting is going to be one of flagging significant global risks. But down the line, I do believe there's scope.
Yeah, global risk does seem to be the order of play at the moment. But remaining sort of on the fiscal position of things, South Africa's fiscal position has shown signs of strong improvement. To what extent is this driven by structural reforms that we've had versus temporary revenue gains from commodities that have been going up quite strongly, particularly the gold miners? And how does this stronger fiscal position influence bond valuation in the next year?
That's a great point to make. Okay, so the split certainly is significant towards the benefits of increased tax revenue from commodity prices and a stable currency. The two have worked quite well actually together. So you've had over the last year, you've had lower oil prices and you've had higher commodity prices. So your terms of trade, that's the difference between the price of exports and imports, has improved for South Africa. So those have been circumstantial, if you like, or incidental improvements that we've benefited from. But the good news is that those are being cared for and treated appropriately in fiscal policy by government. We saw a significant reduction in weekly bond issuance at the medium-term budget last year. So that's an action that the market needs to see, and followed in this year's budget with another weekly bond reduction in the nominal bond space. This is significant, and it shows that the commitment is there to reduce, because you want to consolidate our had been growing debt to GDP ratio, and that was compounded by weaker nominal trend GDP, and we were borrowing more post-COVID. So that was the big dragon to slay, was getting debt to GDP under control, and they're doing it. They're reducing weekly issuance, and the cost of new debt has come down thanks to the credibility of fiscal policy and the improvements overall. So they're getting it right, actually, and they're reducing spending and wasteful expenditure, which has been a big problem in the fiscus too. So that's actually that they are making significant and can do more, of course, but they're making some positive steps in the right direction. And that debt reduction has been key, and also introducing new bonds in the shorter end of the curve to take some pressure off funding, issuing more treasury bills to get that cost down as well. So there's been a big effort to improve the fiscus as well. So I think it goes hand in hand. Of course, we'll take any benefit on terms of trade where we can, but it's good to see that the action is being taken in the ministry too.
It's very comforting words that you're saying, James, because I must say a lot of what you read about fiscal expenditure in South Africa is that it's out of hand, the debt levels are incredibly high. But it is interesting when you look at our debt levels to GDP and other emerging markets and compare that to developed market debt levels at the moment, which is staggering. Most of even sort of fiscal hawks like Germany are currently running a debt to GDP ratio of, a fiscal imbalance of, I think, about 3% deficit. And so you're seeing structurally that developed market debt levels are incredibly high. So it is comforting to hear that in the emerging market space, and particularly in South Africa, you are seeing a reduction in debt and also just cleaning up of some of the wasteful expenditure. So it does paint a more rosy picture than I think a lot of people do realize. I also want to ask you about, it always comes back to the Rand. How should investors factor in Rand volatility when evaluating SA fixed income? Does the current valuation of the currency provide a cushion, or is it a risk?
That is normally, the Rand is a difficult one to address, Nico, as you know, in times of stability. So the Rand has actually improved significantly over the last couple of years for its correlation to the performance of precious metals, but also in response to the US foreign policy, which has been one that seems to favor a weaker dollar, as well as this term de-dollarization, which was a big part of last year and the years ahead or before that, which saw a sort of a global move away from the dollar into diversifying investments away from it that were previously concentrated. So the Rand's been a big beneficiary of that. But the Rand has historically been a proxy for risk. We've heard that because of its deep market, its liquidity, in risk-off environments, the Rand behaves as a risk proxy and sells off. So we're seeing that at the moment. But I think once things settle down, and we don't have a clear answer for when that might be, but as soon as things settle, that trend should continue, especially, we've heard from Karim earlier, their thoughts on gold, the diversified investor base that's supporting their trend and their view for strong gold. And should that continue, well, that certainly bodes well for the rand. Higher real yields in South Africa, that supports us in that carry trade environment too. So I think longer term, the rand still remains unusual for us to say, but stable. But at the moment, of course, it's performing its function as the pressure valve and the risk proxy right now. And it has moved out a weaker significantly. It's sitting at around, I think, 1685, 88 when I last had a look a few minutes ago. And so, yeah, that's something to look through, though. The rand has been enjoying those other points, and I think that's worth considering. And that's been a big attractor for foreign investment flows, too. You've had the double benefit of capital appreciation, higher yields, and currency stability, which made local currency investors into SA go quite, improve or increase their investments last year.
Now, James, in a market where investors can choose between direct bonds, money market funds, income solutions, and the like, what differentiates, and I want to turn to the fund that you manage, and specifically your thinking around managing it and how you put together one-on-one in such a volatile and uncertain world. What differentiates an actively managed income fund, particularly an active income ETF, in terms of risk control, duration flexibility, and yield enhancement? Why would anyone want to allocate to this type of strategy?
That's an excellent question. And I think it's important to differentiate active and passive when it comes to index markets. I mean, Satrix is the biggest in the country, and you have all of those benefits. When it comes to fixed income, though, we don't actually have too many benchmarks to be passive against. If you think about it, you can do it in bonds and you could do it against cash. But in between, there's this big range of opportunity that isn't actually available to passively index. And so the opportunity in having it ETF and all the benefits of that, but put into an active strategy, I think that's something quite novel and important for investors to consider. Because what we try and do with an active income fund like the Satrix Active Income ETF is create a portfolio that sits in between money market and bonds, and that is positioned to be in the best format to get risk-adjusted returns over the foreseeable future that will most benefit its investors. So what we're looking to do is certainly get a pickup over money market, but not have as much duration risk as you would have in a bond fund. And so that would be determined by the current status quo. And that's exactly what we would be doing at the moment. In periods of volatility, there would be a more reduced risk exposure in the portfolio. And then when there are obviously advantages and tactical reasons to extend duration, you would take advantage of those too. So it sits quite nicely in between the money market and bonds. And yeah, you definitely want to see a pickup and to reward those investors whose cash wants to sit in a diversifier like an income fund.
Building resilient portfolios currently, where do you think the emphasis should lie in the fixed income space? On income or on price sensitivity, the potential for capital appreciation from a duration perspective? And the reason I ask you this is, so Karim made a very interesting comment, and in their report, they very much strongly indicated that the role that fixed income plays in their portfolios from an income generation perspective. Are you leaning more into interest rate sensitivity opportunities, price sensitivity, or taking advantage of that? Or are you more comfortable moving it sort of to the front end of the yield curve and earning that income and taking sort of risk on the margin only when it is available? How do you balance this in the current global economic uncertainty?
Excellent point, because I mean, you opened up by highlighting the strong 2 years South African fixed income bonds have had. So I think currently you've got to think that a lot of the capital appreciation is in the bag at the moment. And the strategic positioning now should be to benefit from income. And that's what you want in your portfolio. And I think that's the point, of the global portfolios being made. So I would say you've got to look at the steepness of the yield curve. I think at the moment, you probably want to be somewhere a little bit further down the curve, but not right at the long, most risky point. I think that a lot of that is flat enough now. But I still think there's sufficient steepness out just around the sort of what they call the belly of the curve, maybe the sort of 10 to 15-ish year area. And I think if you combine that with some nice floating rate assets, keeping your duration down perhaps around a 2-year or sub 2-year area, I think that's probably the sweet spot for a portfolio like this at the moment. Of course, you're going to have some volatility. You want to be in this portfolio for periods, I would say, above 3 to 6 months. But that's probably how this portfolio should be structured at the moment.
It's fascinating. Thank you for your insights, James, and for taking the time. I know the markets are wild, and you'd love to keep your eye more closely on the indicators than spend time chatting to us. But thank you very much for the time. Yusuf, I want to come to you quickly. There we go. So Yusuf, lastly, I want to turn to you in order to explain to our clients how an actively managed ETF differs from a traditional ETF. And then after you've explained that, maybe just help us understand why the Satrix Income AM ETF, which James manages, complements the current lineup of Satrix fixed income strategies.
Thanks, Nico. So certainly I think the audience is very familiar with traditional exchange traded funds, right? So, we've seen the market spawn many of these things. Take the Satrix 40 as an example. Take the Satrix S&P 500. It's a very simplistic index construction methodology. So what we do is, we take a household index like the S&P 500 or the FTSE JSE Top 40 index. And what a traditional ETF would do is we would hold weights in the asset class or weights in the stock in the exact same percentage as the index, right? I mean, that's the hallmark of a traditional exchange traded fund. Now, what is interesting, and certainly in the last few years, the JSE has introduced a new type of class. They've introduced a new class of exchange traded fund, a new type of vehicle, right? So it's what they call an active ETF or an AM ETF. And this is a very interesting type of vehicle in that the rules are far less constricted in terms of what a manager can and can't do inside this ETF. So inside an AM ETF, a manager, if he wants to, if he chooses, he can sort of follow an index if he feels. He can, maybe use an index as a loose benchmark if he likes, or alternatively, he can absolutely run the portfolio on a full active basis. And so it's a very interesting asset class that we've seen the JSE allow us to bring to the market in the last few years, right? Now, the reason why this AM ETF is interesting for us is if you just look at the challenges faced in indexing the fixed income space. Now, not all parts of the fixed income market can be indexed easily. And I think this is something that James alluded to earlier in that, if you look at the long part of the curve, if you look at bonds, government bonds, sure, very easy to index that part of the market. We've got government bond indices on which Satrix has launched product. We've got inflation-linked bond indices in which, again, we've also got product. Likewise, in the global bond space, we track the Bloomberg Global Aggregate Bond Index, which is a great global bond proxy. And so all those parts, that part of the market, the far end of the market, very easy to index and not a problem, right? But what we've found is that certainly in the shorter term paper, right? So if you look at something, the duration, and you look at maturities a little bit less than bonds. So you look at NCDs, T-bills, promissory notes, everything around the 1 year point, 2 year point. It's very difficult to get a investable index. I mean, the market knows, and the market is very familiar with the Steffi index. But the problem with the Steffi index is that the Steffi index in its own right is not an investable index. I mean, you cannot unpack the Steffi recipe and invest in the Steffi ratio to achieve Steffi returns. All the Steffi index does is it kind of just reports a performance number for a cluster of instruments, but you cannot. It's very difficult to replicate exactly in line, with the Steffi, and so that's why we're pretty excited about this space, in that what was missing for a long time from the Satrix product set was a product that kind of plays just south of the bond curve, but just more than cash. So slightly more than cash, but less than bonds, right? Sort of like the 2-year duration, or maybe just something just less than that. And in this regard, we launched the Satrix Income AM ETF a month ago, which we're quite excited about. I mean, this fund is an actively managed ETF. It's managed by James on the line from 91. Obviously James has had a very strong and successful track record of consistently delivering strong risk-adjusted performances in this space, and so we're hugely excited to be partnering up with James and 91 on this. Further, James shares the benefit of being part of a globally integrated fixed income team at 91, and the largest fixed income team in SA, which are all the hallmarks which we like, for this strategy. And so certainly this fund that we've launched is an actively managed fund. Very simplistically, it allows James to take advantages of the opportunities that exist. So often, and it depends where we are on the interest rate cycle. James might see a bit of value on the bonds, and it'll allow him to take a little bit of positions on the bonds. Or alternatively, he might like the shorter term paper, and that ability to play the curve, is what we're usually excited about. Ultimately, this fund aims to deliver to investors in excess of about 1% over the average money market fund, which we think is super appealing. And yeah, we're super excited about the launch of this new fund.
It's such an interesting point that you make, because if you compare our local benchmark bond indices to something like the global aggregate, few people know that the global aggregate bond index has about roughly 20% credit instruments, has about a 17% EM debt exposure. So there's a lot more than just, it's not a developed market bond index per se. Your point is an investable money market benchmark index directly there, as well as just adding more opportunities in the bond space. And so do you see this actively managed ETF play sort of nicely with our other offerings? Because I think a lot of investors would look at the Satrix and say, what we do fundamentally is provide low-cost index building block solutions, and they've come to expect that from us. But then seeing sort of a label of active around an ETF, they might find this strange. So what you're saying, if I'm summarizing it correctly, Yusuf, is that there is an opportunity for differentiating from the benchmark, because it isn't cut and paste, just, this is a simple benchmark that we're tracking. As, for example, in the equity space, our benchmarks, top 40 all share, is absolutely active manager efforts are what defines the weights. Whereas in the fixed income space, you of course have Treasury coming to the market, issuing new debt, and you have a different market altogether. So you do see it playing nicely together and offering our investors something else and something of value that we're bringing to clients.
Yeah, absolutely. I mean, as you've touched on, at Satrix, it's very important to us to bring the most purest version of a vehicle to an asset class, right? So when we think of let's say the US market, we find that the S&P 500 is hard to beat, and we would bring that to the market in an S&P 500 exchange traded fund. When we think of South African equities, as an example, let's take the large caps. Satrix 40 is a great representation of that space. And I think likewise, when it comes to the fixed income space, specifically between cash and bonds, there is definitely a gap in that there is no index, in our opinion, that plays adequately to that space. And that's why we are comfortable that this strategy is, in our mind, the most purest version of playing into that space. In capturing exactly that part of the yield curve in a way that investors can, diversify or, be able to add a very pure version of this play to the overall portfolio.
No, thanks for that, Yusuf. And it's really an interesting offering. I want to get James back online quickly. I did say we're going to give you some rest there, James, but sorry to pull you back in onto the screen again. So we have two questions that are particularly directed at you. The first is just your view on SA money market instruments, and I suppose that would be, again, in the context of a sort of broader diversification or belly. I accept that, and I think that is quite interesting. But a second question, I think this is a lot of our listeners will want to have your views on this, but might not, didn't sort of hit the Q&A button. And it's specifically around your prediction for the Rand dollar over the next sort of 5 to 10 years, just a longer term view on the Rand. Now, I know asking anyone their view on the Rand, I normally just say, well, the Rand's going to go up and then it's going to go down. It might not be in that order. That's basically the only view I have on the Rand. But I'd like to get your view on the currency, the underlying dynamics driving the currency, specifically from the perspective that what we've seen over the last 10, 15 years, the Rand has been remarkably stable in terms of its valuation. If you compare it to the Turkish lira, Brazilian real, other similar EMs, the Rand has actually been quite stable. And I think a large part of that, we've done internal research that shows a large part of that stability actually comes from carry trade and the attractiveness of the local currency, specifically the depth and liquidity of our bond markets, and also the strength of our institutions. Now, that carry trade has carried the Rand and made it more stable over time. Would you agree with that? And that's a very long question, James, but sort of looking medium to long term, do you see the carry trade persisting and sort of stabilizing the currency long term?
Yeah, that's a really good point and a difficult one, as you say. I loved your point on up and down, because that is often how it feels. But the Rand, prior to the sort of positive developments post government of national unity, where we saw the Rand and bonds suddenly recalibrate those risk premia out, the Rand typically depreciated according to its differentiated inflation, or its inflation differential to the currency it's quoted against. So you look at what US inflation expectations were. They sit around 2%. Our longer term inflation expectations were around 8%. And you'd factor in that difference, that sort of 6% depreciation over the course of the years ahead. It wouldn't just go in a straight line. It obviously trends, and that would be then supported in periods by this carry trade that you speak of. And that typically is how the Rand had been behaving. It's turned around and it's moving because of the fundamental improvements that we've had. And so those terms of trade benefits will show up, and that will support the currency. So if we think about where our longer-term inflation trajectory looks now, we've got those 5-year break-evens. They've moved higher, of course, now, but they were sitting at around 3.5%. And with the US, who's also had theirs move higher, but theirs was closer to sort of 2.5%, which would mean theoretically there's some weakness in the Rand, but it may be coming off an overly weak level. It's a convoluted answer as well coming through. But ultimately, the feeling is, and I know this has been the feeling with a lot of economists, that there should be a stable to stronger Rand still, so long as this precious metal and commodity price improvement is maintained, and that the oil price stays a little stable, which of course that's the unknown at the moment. Where does the Rand go? To put a level on it, that's difficult. And I always think coming back to being a portfolio manager, and if I'm building a portfolio for a South African-based investor, I can't ignore offshore. So I can't say that there's a reason to not put offshore investments in a portfolio when your income is purely denominated in one currency. And I think that's the key to investing. So irrespective of the carry opportunities, that will of course improve other assets like equities and like bonds. I'd still think I would want to be in a position where I'm diversified with a little bit of offshore. So yeah, I think even in periods of rand stability, it's good to be diversified. And that, that's played out in the shock that we've seen over the last week. We've seen the rand move from closer to 16, approaching 17 at the moment. So yeah, I do think, long story short, rand stability on a 5 to 10 year outlook, I would expect rand weakness in line with inflation differentials. And, it is something that you would look to strategically for that carry opportunity. I hope that is not too confusing and convoluted a response there, Nico.
Not at all. The question was confusing and convoluted. The answer was precise and clear. I thank you for that. And I thank you, James, Kareem, Yusuf, thank you for your time, for the wonderful insights that you shared. And for all of you that dialed in, we thank you for your time and for attending, and we hope to see you again at our next IndexMore webinar. Thank you.